The past couple years have been challenging for the restaurant industry, especially the full-service dining sector. But there's one set of restaurants bucking the trend: Texas Roadhouse and LongHorn Steakhouse.
They really are standing sort of above their peer group in terms of overall performance and in terms of just growth and success right now in the restaurant business.
Between 2019 and 2024, the two companies' sales are up over 55% and over 80%. In 2024, Texas Roadhouse became the biggest casual dining restaurant, surpassing Olive Garden, who held the top spot since 2018.
These value steakhouses exist in kind of the sweet spot where it's tough to replicate the experience. I think that's why you've seen Roadhouse and LongHorn deliver trends that are, above what the industry is seeing.
So what's driving consumers to these steakhouses, and what makes them a standout in the restaurant sector? Texas Roadhouse and LongHorn Steakhouse parent company Darden Restaurants have significantly outperformed the S&P over the past 5 years. Darden Restaurants owns a number of chains besides LongHorn. Olive Garden is the most profitable and by far the biggest of its brands, having done over $5 billion in sales in fiscal 2024. LongHorn Steakhouse represents about 25% of the business, but most importantly, it's the company's fastest growing segment.
There's something about steak that it really rings true to the consumer as still being kind of an elevated or a premium consumption or dining experience. And so I think it's fair to say that it has been a key growth driver for the stock and something that investors are always keen to focus on whenever Darden reports their earnings and to see how LongHorn is performing.
Here's a look at LongHorn's quarterly same-store sales growth compared to Darden's other businesses. While LongHorn Steakhouse has been growing its sales, Olive Garden's performance has been relatively flat, and some of the fine dining concepts like the Capitol Grill have been a drag on the portfolio. In its fiscal 2025 third quarter, LongHorn sales increased about 2.5%, which was only about half the growth analysts were expecting. However, it was still a standout for Darden.
The fact that LongHorn, they missed maybe what their expectations were, but still posted some positive same-store sales numbers in a really challenging environment, I think is still good news. Maybe it's not the best news for Darden, but it's still, I think, better than what a lot of the other casual dining chains will end up reporting as we get into the earnings season here.
So over the next 12 months, we have an equal weight rating on Darden and would expect the stock to perform kind of in line with the broader restaurant sector. We do expect Texas Roadhouse to deliver trends that are above the industry, but already trades at a higher valuation than the rest of the industry. And so we think that outperformance over the next 12 months is already priced into the stock.
Steak is often associated with high-end restaurants whose price points may be out of reach for the average US consumer. These chains have made steak accessible. Experts say that value is one of the primary reasons why these restaurants are outperforming. Plus, there's a major focus put on experience, portion sizes, for example, at LongHorn, or a strong workplace culture at Texas Roadhouse. The company offers its restaurant managers the option to earn a percentage of the store's profits.
You can't underestimate the investment that these chains make in their general managers at the store level, right? The store level manager really is probably the most critical piece to any restaurant chain's success. And so I think Texas Roadhouse, to a great degree, I think LongHorn as well, do a really good job of developing that, sort of local unit level talent and give them the tools to succeed.
An uncooked ribeye at a grocery store near our studio here in Englewood Cliffs, New Jersey, costs about $22 for a 20-ounce steak. A ribeye of the same size and cut, cooked any way you like it at a Texas Roadhouse about 8 miles away, is only $9 more. And it comes with two sides, like fries or veggies. This relatively small price difference has especially benefited these value steakhouses.
Particularly in periods where we see food inflation, inflation in beef in particular, consumers develop what we would kind of refer to as a meat anxiety. What we'll actually see is consumers will opt to not buy steak at the grocery store, even though on a dollar price point, it would be cheaper than going to a Texas Roadhouse or a LongHorn, and opt to have their steak consumption done at these value steakhouses because they know it's going to be cooked right If it's not cooked right, they can get a new meal.
One prominent challenge that steakhouses must contend with is the volatile cost of beef. To manage these costs, Texas Roadhouse and LongHorn Steakhouse secure contracts for meat far in advance of when they will need it.
What they are basically doing is negotiating prices on not only beef, but on beverage, on potatoes, on side dishes, on alcohol. So you've got these big procurement offices at Texas Roadhouse and at Darden that has set up essentially a pricing program. And then as general manager, you're just buying off of that, at a negotiated price. I think these are sort of abilities that larger chains have that some of the smaller mom and pops don't have.
That does, of course, leave some risk for the market price to drop below the contracted price. But locking in costs in advance creates predictability and allows operators to focus on other parts of their business. The chains are also working to keep prices below inflation. For example, Texas Roadhouse said its prices are up just over 2% year over year in its second quarter of 2025. Meanwhile, it expects overall commodity costs to increase 3 to 4% for the year. By absorbing some of those inflation costs, the restaurant hopes to draw in more customers.
You hope that you make that up either in the more people you have through the restaurant, or you hope that you make it up and they eat more sides so they get more drinks. Because the good thing is, once you have them in the restaurant, then you have your staff there to hopefully, hey, let's tack on a dessert, let's tack on an appetizer. There's all kind of opportunities to add incremental purchases to the overall ticket.
But being a budget steakhouse isn't a winning formula on its own. Outback Steakhouse is the largest steakhouse chain by number of locations, but makes significantly less per restaurant than both Texas Roadhouse and LongHorn Steakhouse. Its foot traffic has also been declining for the past 3 years.
I think with Outback, that brand is still in the process of really optimizing their in-store operations, the menu offering, and finding that right balance of value, both from a portion size, overall experience in the restaurants, and then the actual value from the amount of food you're getting. LongHorn and Roadhouse are more established operators.
Outback is over 20% franchised, while LongHorn Steakhouse and Texas Roadhouse are less than 10%.
The trend right now tends to be toward restaurants franchising more rather than owning and running company-owned stores. I think that ownership and the management that you can give that and the autonomy that gives you as a restaurant company when you own your own stores, I think that certainly helps, especially in a category like this.
Outback's 2024 check average is also higher than its peers, and its menu has become too big for its own good. In February 2025, the chain announced that it was shrinking its offering by nearly 20%. The CEO of its parent company, Bloomin Brands, said, quote, "We need to make fewer items, but we need to make those much better," on its 2024 fiscal fourth quarter earnings call.
Bloomin Brands' share price dropped 17% midday on February 26th, when it reported 2025 guidance that was lower than Wall Street's estimates.
The playbook itself isn't hard to do. It's simplify, it's innovate, it's give your people what they need and really invest in the people and do it at a price point that consumers are going to find palatable. It's easy to say, it's hard to do. And I think as long as both LongHorn and Texas Roadhouse continue to have that formula and continue to do that, clearly they've found a niche that consumers are going to continue to come back. And so I would be generally pretty optimistic about their future